Well, did you have a little bit of the sip from the fire hose in our last presentation? Yeah, it's hard to get your arms around this industry, but it's something that many people do every year. Some do it better than others, and you're going to be one of the better ones. I am sure of it. So let us finish mutual funds with a few odds and ends. We'll discuss some fund families, a few other characteristics of funds, and then we'll take a look at a sample mutual fund and see what one good, well-written, well-managed fund that has been around for decades has done for us investors. So let's start on slide number 16, fund families. A family of funds exists when one investment company manages a group of mutual funds. At the beginning of the mutual fund industry in the 20s, 30s, 40s, and 50s, usually a company would have one, maybe two funds. But then the competition started to heat up, and we saw the number of funds explode. Some of these fund families have hundreds of funds. Yeah, and of course, if one has a growth and income international large cap fund, then they all have to have it, as we saw in the previous presentation. The funds in the family vary in their objectives, right? And you can move your money from one fund to another within the fund family without having to pay all those extra fees that you did when you started, right? But the IRS says, no, wait a minute. If this is in a taxable account, you've changed your investment. Even though you're with the same company, every fund is a different investment. So if you're in a taxable regular account, and we discuss that a little bit in Chapter 11, and we'll discuss tax-qualified accounts for retirement in detail in Chapter 14, then you're going to pay you're going to have to divvy up. You're going to have to square up with the IRS, whether you have a capital gain or a capital loss. If it's in a tax-qualified account, a 401k, a Roth IRA, then no, that doesn't apply. You wait until you take the money out. In the case of the Roth, you never pay taxes. So Forbes has this wonderful saying, choose a family, not a fund. And I like that. It's been around for decades, that saying, and I really agree. Look for a company that has a goodly amount of mutual funds, but all of them are well run. And many of the older companies would allow, funds that really weren't that great to stick around, and they'd throw all their advertising around the really, popular ones, and that bothers me. I'd rather see a company that has not too many choices, but they're all good. No ugly ducklings. But everyone's different, right? Everyone's different. And I forgot to mention that we said that you can move your money around, but don't do it every month. Don't do it every week, certainly. Every 6 months, a year at the most, folks. You just really don't want to play market timing with mutual funds. They're long-term investments. In fact, if you try to do that, different companies will do different things. Some will charge you. They'll say, look, you want to move your money around like that? Sure, we'll charge you. Where does the money go? It goes back into the fund and helps your fellow investors, because that's not what mutual funds are for. Other companies just simply won't let you do it. They'll give you, you can do 10 a year, one a month maybe, but after that they say no more, right? No more. Just stop. That's not what mutual funds are for. They're long-term investments. Slide number 17. And here are the top 10 fund families. Now, this data is a little suspect, dear students. Why? Because of the way we measure the size of different companies. BlackRock, for example, which is number 8 in mutual funds, is actually one of the world's largest money managers. It's just that many of their vehicles are other than mutual funds. So this is just trying to measure mutual funds. So you look at different sources, and you'll see different pieces of information. And this is the best one I could find, and it's several years old. So if you find something better, and be careful though. Some of them, some of them are. You look at it and you say, no, that can't be right. Dear students, it just can't be right. What you're telling me, that can't be the third largest fund family. There's no way. By far, the biggest one is Vanguard. Now, Vanguard surpassed Fidelity. I don't know, about 15, 20 years ago, and on the strength of their index funds. They still have actively managed funds, and when they trumpet these index funds, I always have to ask, I want to just ask the CEO, oh yeah, well how come you keep your actively managed funds around? But who am I? I'll just keep my mouth shut. The next two, sometimes American Funds is bigger than Fidelity, sometimes Fidelity is bigger than American. But American Funds is actually run by a company called Capital Research and Management. And very few people have ever even heard of the company. They're quiet. They're very quiet. They do a tiny amount of advertising. They certainly don't do any television advertising like Vanguard and Fidelity and some of the others. But they're a very well-run company. Very well-run company. Been around since the 1930s. For decades, Fidelity was the number one company. By the way, Vanguard's based outside of Philadelphia. American Fund's based in Los Angeles, if you can believe that. But they're all over the world. And Fidelity's based in Boston, the venerable seat, the venerable home of many mutual fund companies. And they have hundreds of funds. Now, in the face-to-face class, we would now stop and show you Fidelity's funds, Vanguard's funds, American's funds, because Fidelity it's just a sip from the fire hose. There are hundreds of funds. I mean, where do you start? Vanguard has a lot of funds too, but not as many. A little less than 200. And then American, they used to have about 30. Now they have a few more. What they've done is they've bundled some of their funds into other funds. What I like about American is that you can see it all on one page, and you can see from the riskiest funds down to the least risky, and it shows you their long-term results. It doesn't show you how volatile they were, right? But just know that the riskier funds are going to be more volatile. And then we show the face-to-face students the 2008 results, which is very humbling, dear students. The growth funds lost 50%, 40%. The growth and incomes lost 38%. The equity income lost 30%. The balance funds lost 30%. The bond funds lost 15% and 10%. So you see that's the difference between risky stocks, and some stocks are riskier than others, and less riskier funds that invest in bonds. And of course, the money market didn't lose any money. But of course, they don't make that much money. The one fund, other than the money market, that did well was the government securities, the treasuries, the United States government bonds, because everybody rushed to bonds in the disaster, in the volatility, in the turmoil. Now, some of these other companies are very good. I'm not a big fan of Columbia, but PIMCO has been around for a long time. They're based in Newport Beach. They had the distinction of having the largest fund in the world for a while, but not anymore. Franklin Templeton is an excellent company. They're, again, based all around the world. They're somewhere up in California, Northern California. I thought they were in L.A., but they're actually farther north. But they have excellent funds. I remember Sir John Templeton, yeah. And then T. Rowe Price, based in Baltimore, if you can believe that. Another very good company. Check out their options, because they have some very good options. And so those, not PIMCO, but the first six, except for PIMCO, the websites are on the class website. They're in Canvas also. And then there's another one that's not in the top 10, but they're actually a very, very good company, but they're very strange. They only have 6 funds or 5 funds, and that's Dodge & Cox. Dodge & Cox, based in San Francisco. They've been around since the 1930s. Excellent mutual fund company. Take a look at them. As we said, BlackRock is a very smart company, and they're very large. They actually have the 401k plan for the United States government, federal employees, called the Thrift Savings Plan. And yeah, they're not stupid. They got that, and I'm sure it's making a good bit of money for them. J.P. Morgan bought a bunch of mutual fund companies, and now they're number 9. And Oppenheimer, another pretty decent company that's been around for decades and has some pretty darn good funds. So check these out, or check the ones that you have out, or in your 401k or your 403b or whatever, because that's the joy. I know it sounds like joy of investing, but the joy of investing to me is that there is never any end to how much you can learn. You can research and from today until the day you die, and you will never, ever learn all the companies, because there's thousands of them out there. Yeah, and I like it. I love learning new things and learning about companies, and so that's what I do for fun and games. So you take that for what it's worth. Slide number 18. Oops. I'm sorry. Let's go back. I goofed. Because of the mutual fund scandals of 2003, 3 of the companies that used to be amongst the top 10 are no longer here. Putnam, Alliance, both excellent companies. And who was the third? Oh, Janus, yeah. I'm not a big fan of Janus, but that doesn't mean they don't have good funds. But they're gone. They're out of the top 10. What happened? Wait a minute, Piano, slide 18. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, yes, as a matter of fact, I do. Since 1940, remember the Investment Company Act of 1940? The mutual fund industry has been regulated and escaped any hint of impropriety. That's a fancy word for hanky-panky. Travesuras, trucos, things that they shouldn't be doing. And in 2003, some practices that were not quite illegal, but obviously unethical, were uncovered. It was only a handful of funds that were affected, folks. Only a handful of people. Poor Alliance. Alliance had 2 people in a huge organization that were doing these things. And, poof, they got tarred with the bad brush, the bad company, and they lost lots of clients. And it was just 2 people. And what were they doing? Well, it wasn't illegal, but remember we said we don't want to trade mutual funds. We don't want to buy and sell mutual funds. You want to buy and hold them. Well, some of these people were not doing that. They were buying and selling and buying and selling and a few other things that we're not going to get into. But they were stealing pennies, not even pennies, little slices of pennies from their fellow mutual fund investors. Why would you do that? Well, when there are, when you're dealing with millions of dollars, stealing pennies from each other, millions of investors, it adds up very quickly. And the one fund that was the saddest was Strong Funds. And it was the guy who started it, who built this company from nothing into a huge mutual fund company that's now been bought up by it. It's merged into other companies. It's gone, but look him up, Mr. Strong. He destroyed his life. And it's the weirdest thing. I think he was worth $60 million or $600 million at the time, or whatever it was. It was some outrageous number, and he basically made about $80,000 from his shenanigans. Now, to you and me, $80,000 is a lot of money, but to somebody who's worth $60 million or $600 million or whatever he was worth, that's nothing, And he was very circumspect and very contrite. He said, I ruined my life. I let everybody who admired me, who loved me down. And for what? For very little, really, for very little. And you get to the point where you start to believe everybody's telling you how wonderful and fabulous and fantastic you are, and you're invincible and you can't do anything wrong. And it turns out that, no, you're just human like the rest of us. So you have to be careful. And I look for that. I know it might sound silly, but I look for humility when I talk to people and research people in the industry who are investment people. I watch and listen and read and try to coax out that one trait, because we're not gods. We're fallible. We're humans. Yeah. Slide number 19. So, okay, all right, how do I pick a mutual fund? It's not easy. As I said back in chapter 11, it's just not, once you've chosen the mutual fund, then it's not much you have to do. But picking the mutual fund itself is not hard. It's not easy. It's not easy. So my humble opinion, pick a mutual fund that invests in high-quality stocks or bonds, is well diversified across several industries and sectors of the economy, has a long-term perspective, and a manager, or better yet, a team of managers with many years of experience. What you want to do is avoid companies that shuffle their managers every few years like a pack of cards. Now, this used to be the way most of the industry worked. The industry is changing. They're realizing that this is not the best way to treat their managers. What they would do is they'd take somebody out of, Wharton School of Business or Harvard or Stanford or some University of Chicago, some very prestigious business school, and they'd say, here you are, kid, here's $1 billion. Have at it. Well, these people are not stupid, folks, and they realize that if they don't do well in the next 18 months, 2 years, they're out. They're on their butt, out the door. And so they have a tendency to take more risks than they normally would because, hey, if they do well, they get to stay, get showered with love and affection and a hell of a lot of money. And if they didn't do well, oh well, they knew they were going to get kicked out anyway. And now the companies have realized that, it's not the best way to run a mutual fund. And so fewer and fewer are doing that. And the most important thing is longevity. They've been around for a long time. Decades is my humble opinion. You want some companies been around for a long time. And I know that sort of says, well, what about the new companies that start up? What about them? What if they come up with something better? Well, all right. You decide. But I want to see people who have performed consistently well in both good times and bad times. I don't even want you to tell me how well you've done in the good times. Any idiot, yours truly included, can do well in the good times. I want to know how well you did when the organic matter hit the ventilating device. Because you know what, folks? It's going to happen. You don't know when, you don't know how often, you don't know how bad it's going to be, but we know it's going to happen. And that's when, in my humble opinion, that's when the mutual fund managers earn their money. How did they hold up during the bad times? Did they panic? Did they just fall like a stone because they had bought the most riskiest things out there, just hoping to juice their returns in the short term? Yeah. And so take a look at how well they did in good times and bad times. And so now on slide 20 is when we would pass out some information, and it's on the website, it's in Canvas. How did this company do, this one mutual fund, over 84 years? Is that long enough for you? And it turns out that this mutual fund, the sample mutual fund, there are others like it, don't think I'm saying you have to invest with this one, has done 12% over 84 years. Now remember, we tell people that you should get 8, 9, 10% over the long term with stocks. And here's a mutual fund that's done 12% since 1934. And there are a few pieces of information that we have on the handouts that we pass out. Stocks have been risky, yes. Well, sure. In the short term, yeah, you're going to lose some money sometimes. Sometimes you're going to lose a lot of money. But over the long term, as long as we didn't panic, kept investing consistently, no. As the global economy has expanded and our standard of living has increased exponentially over the decades, and now is happening all around the world, the stock market has responded accordingly. And I believe the best is yet to come, dear students. Even with all the ups and downs, when we have the vast majority of people on this earth well-fed, well-clothed, well-sheltered, with their cell phones and internet access, and their Disney CDs or whatever for the kids, and the bicycles and cell phones and everything. Yeah, I'm really optimistic. I know it sounds ridiculous because it looks like the world's going to hell in a handbasket. I'm very optimistic. Assuming we don't blow ourselves up, die in our own waste, Ebola, tsunami, meteorite, disco returning. And how about now being a good time to invest or not? Well, there's another piece that shows you if you invested on the best day and if you invested on the worst day over the last 20 years. And it turns out, as long as you stuck it out, you did okay, even if you invested on the worst day or best day. But you're not going to invest on the worst day. You're not going to invest on the best day. You're going to be putting $50, $100 more if you can afford it into a mutual fund through your 401k, through your Roth IRA. And so some days you're going to pick the best day, and some days you're going to pick the worst day, and most of the time you're just going to be average. Speaking of which, what do we do when the market turns against us? Keep a long-term perspective and dollar cost average. What a dumb name! I wish I could. I've been trying to think of a better name, but I haven't heard any better names. Slide number 21. This should look familiar because we showed it to you back in chapter 11. Dollar cost averaging is a terrible name, but it's a wonderful system. It's a system of buying an investment at regular intervals with a fixed dollar amount. With dollar cost averaging, folks, this is the best part. There's always good news. No matter what happens when you wake up in the morning, there's good news. See, I told this to my wife many years ago because she was frightened. She was a little worried about investing in stocks, which you should be. I said, no matter what happens, Anita, because that's her name, Anita, when we wake up in the morning, there's good news. Either the market's up, good news, yippee, your account is worth more. Or the market's down. Good news. What? Huh? Good news? Yeah, next month. When your $50 or $100 a month comes out of your paycheck or checking account, you're going to get more shares because the prices will be lower. When do you want to buy? After JCPenney's and Macy's raises their prices 100%, is that when you want to buy? No, you want to wait until they drop their prices 50%, right? But that's not the way people are in the stock market. They wait until the price goes up 100%, then they go, okay, must be a good time to invest. Ooh, is it too late to get in? And then when there's a sale, 20, 30, 40%, ooh, is it too late to get out? Instead of rushing in and saying, I got my $50, I want to buy. Slide 22. Hypotheticals. Most mutual fund companies have a system for running what are called hypotheticals or illustrations or hypothetical illustrations. They're examples of returns of investments for either a lump sum principal or a series of investments, a stream of investments. Sound familiar? Well, that's what dollar cost averaging is, really. It's a series of deposits. They must be approved by the Securities and Exchange Commission and the Financial Industry Regulatory Authority and contain disclaimers about past versus future performance. Be very afraid. Investments are not FDIC insured or by a bank or any other entity, or you may lose money. Investments are not guaranteed. Future results are not guaranteed. It's all there, but nobody reads it. It's all legalese. And so in the face-to-face class now, we would take a look at some of these, as we've done in chapters 11 and 12. And so you can do that now or later. It's in Canvas. It's on the website. Check out how well we've done. And in this case, instead of using a bond fund or a stock fund, in this chapter, we've used a balance fund. So we want to eat well and we want to sleep well. And it turns out that we've done okay. But it's not a guarantee, right? You know that already. Okay, good. Glad to hear it. 23. And I'm not trying to sell you the ICA, the Investment Company of America, the one we use in the class. No, I'm just using that for an example because you got to look at least one, right? Even though there are thousands. But this slide is way back from chapter 1 when we told you at the very beginning of the semester that if you just started investing routinely, take some of that money that we normally send to Nike and FedEx and AT&T and Home Depot and all the other places that we spend our money at and send it to our own investments, we should do well. We should do well. And here are mutual funds. Again, there's Franklin. Remember we told you how great Franklin is? There's Fidelity. There's Dodge and Cox. T. Rowe Price, Putnam, and the American funds. There's 4. There are AM Cap, American Mutual, Investment Company America, Washington Mutual. There's a Vanguard Windsor. Very good fund. Been around a long time. Dreyfus, good company. MFS, I think MFS has the distinction of having the oldest mutual fund. But check these out. These have been around for more than 50 years. 11 and a half, almost 12. 12, there's the Investment Company of America. 13 T. Rowe Price small cap stock fund since 1956. Go back to chapter 1 and rerun those the future value calculations with 13%. Yeah, that's an eye-opener. Slide number 24. So what's the bottom line on mutual funds? The bottom line is, folks, is choose a fund family, stick with them. And there's a saying in the industry that's been proven to be true. Most mutual fund investors do worse than the mutual funds they invest in. What? How could you do worse than the things that you invest in? It's very easy. You wait until the market goes up 100%, you stick your money in the mutual fund, then when it goes down 30, 40%, you take your money out. You buy high, sell low. And people do it, folks. In the 123 class, we do more investigation into this phenomenon, but it's already been shown that people have a tendency to buy when everyone else is buying. Ooh, is it too late to get in? And they tend to sell when everybody else is selling. Ooh, is it too late to get out? And you're not going to be one of them. You hear me? Or I'll haunt you. Reevaluate your mutual funds periodically, but make changes judiciously and sparingly. Don't you love those words? Judiciously, sparingly. As you approach retirement, migrate from stock funds to bond funds, but don't give up on stocks entirely. Look at those illustrations. And when we get to chapter 14, we're going to take a look at the distribution phase. We're going to take a look at what happens when we start taking the money out for our retirement. All right? Use dollar cost averaging. $50 a month, $100 a month, $25 a month if you're younger, whatever you can afford. But for the most part, forget about them. I know, it makes investing boring. But it works. Mutual funds will bore you to wealth. Okay? Now, in our next chapter, which they took out of the book, which I'm putting back in a form of lecture, we're going to discuss real estate and other investment alternatives that I hope you stay far away from. But there are some people out there that they actually make sense for. Not too many. Turns out real estate can be very profitable. But boy, the beta factor is high, unlike mutual funds, where the beta factor is very low. Low. Remember the beta factor from the first presentation? Go back and look at it. Thank you again, dear students. We are so happy, privileged, honored that you're still with us this far. And we want this to be the best class you ever taken. We want you to be fabulously wealthy and successful. And I know it sounds like an advertisement, but it's sincere. See you.